Imagine this. You buy a bond, you're expecting years of steady income, right? And then suddenly the issuer just says, thanks, but we'll take that back now, early.
Yeah, just like that.
And it often happens, doesn't it, right when interest rates have dipped, making it really tough for you, the investor, to find somewhere else to put that money that pays nearly as well.
Oh, absolutely. It happens, I'd say, more often than many people realize in the U.S. bond market. It's a fundamental feature, really, of a huge chunk of the debt out there. Corporate bonds, agency bonds, even munis. They call it a bond call provision.
So that's what we're diving into today. Bond call provisions, what are they exactly? Why do issuers even bother putting them in? And maybe more importantly for our listeners, what are the real risks and downsides for you, the investor?
And are there any protections? Anything built in to shield the bondholder a bit?
Right. And we're even going to get a little technical peek behind the curtain at how big institutions account for these things. Plus, what some academic research tells us about why companies decide to issue callable debt in the first place.
Yeah, we've got quite a stack of material here. We've pulled insights from places like Investopedia and Charles Schwab. They cover the practical side for investors pretty well.
Okay.
Then we've got a more academic angle, looking at a study from the University of Florida.
Yep.
They did big statistical analysis, trying to figure out the factors that made companies issue callable bonds way back when.
Interesting.
And yeah, like you said, we'll touch on the accounting rules too, referencing some guidance from the Fed based on a FASB update.
So it's a real mix. We're going from the what is it and how does it hit my wallet all the way to the why issuers do it and the nitty-gritty, how the big players track it.
Mm-hmm.
Our mission really is just to unpack this whole concept so you can be, better informed about this thing that pops up all over the bond market.
Absolutely, because understanding that call provision, it's critical. It fundamentally changes how you should think about that bond's lifespan. You know?
Okay, let's do it. Let's unpack this. Starting right at the beginning, the absolute basics. What makes a callable bond different from just a regular, plain manila bond?
Well, at its core, a callable bond is just a type of debt where the issuer, the company or agency that borrowed the money, they keep the right, crucially not the obligation, but the right.
The option.
Exactly, the option to buy back, to redeem the bond before its official final maturity date.
So, unlike a standard bond where it's a firm promise, we'll pay you back on this date, period, a callable bond has this kind of escape hatch for the issuer built in.
That's a great way to put it, an escape hatch. And it's not just informal. It's written right into the bond's legal contract. That contract's called the trust indenture.
Ah, the fine print.
The very fine print. And that specific clause is the call provision or the call feature. It spells out exactly how and when the issuer can use this, right? Like the dates they can call it, and importantly, the price they have to pay if they do.
And just having that clause in there, that's what makes the bond callable.
Okay, so the big question then is why? Why would an issuer want this option? Why build in a way to pay back money early, maybe even before they finished whatever project they raised the money for?
The sources we looked at are really, really clear on the main reason. The biggest driver, by far. It all comes down to changing interest rates in the market.
Ah, okay. The refinancing angle, like refinancing your mortgage.
Precisely. Think about it from the issuer's shoes. Let's say a company issued a 20-year bond maybe 10 years ago, and they locked in a coupon rate of, say, 6%, because that's just where rates were back then.
Okay, so they've been paying 6% for a decade.
Yep, happily paying out that 6% interest every year to the bondholders.
Oh.
And now, flash forward 10 years, and market interest rates have tanked. Maybe new debt is going for only 3%.
Ouch. They're paying double the current rate. Exactly. They're stuck paying 6% on that old bond, while they could borrow fresh money today at half the cost.
Oh.
Now, if that original bond had a call provision, and if they're past any initial no-call period, we'll definitely talk more about that protection later.
Right.
Then they can pull the trigger. They announce, we're calling the bond. They pay the bondholders back whatever the pre-agreed call price is, and then, boom, they turn around and issue new bonds at the current, much lower 3% rate.
And over those remaining 10 years that the original bond would have run, they potentially save a ton of cash on interest payments.
A massive amount. It's almost purely an economic calculation driven by where interest rates have moved. It gives the issuer flexibility to manage their debt load actively. It really is just like a homeowner refinancing a high-rate mortgage when rates drop.
Yeah.
That flexibility is valuable, and that's the main reason they built a call feature in.
Okay, so they call the bond to save money on interest. Makes sense. What price do they actually pay the bondholder when they do this? Is it just always the face value, the par value, usually $1,000, right?
Well, the sources do say the call price is often par value, yeah. But the key thing is, the specific price is spelled out, black and white, in that trust indenture we mentioned. It could be par, it could be slightly above par, a small premium. Sometimes with certain types of calls we might get into, it could even be a large premium.
Yeah.
But the crucial point is that it's a predetermined price or formula. It's not a negotiation.
Got it. And this predetermined price, especially if it's just par, that has a big knock-on effect on how the bond trades in the market, doesn't it? Particularly when rates are falling.
Oh, absolutely. Huge implication.
Yeah.
Think about a regular non-callable bond. If market yields fall way below that bond's coupon rate, say, you have a 6% coupon bond in a world where new bonds pay 3%.
That 6% bond looks pretty good.
It looks fantastic. So its price will naturally rise above par, maybe well above $1,000, as investors compete for that higher yield. But now take a callable bond, one that could be called soon, maybe a par, $1,000. Even if rates fall to 3%, why would you, as an investor, pay, say, $1,050 for that bond in the secondary market?
Because the issuer could just turn around and say, thanks, here's your $1,000 back.
Exactly. The risk, the possibility that the issuer will just call it back at $1,000 puts a lid on how high its price can go. Sort of caps the potential upside right around that call price.
Right. So it puts a very real ceiling on your potential capital gains if you're holding that bond when interest rates drop, which I guess leads us neatly into the other side of the coin, the investor's perspective. If the issuer gets this big benefit, what's the downside? What's the risk for you, the person holding that bond?
And that brings us squarely to the concept of call risk. Investopedia defines it pretty clearly. It's basically the risk that the issuer will actually use their option, that they will redeem the bond before its planned maturity date.
Okay, call risk. But how does that really hurt the bondholder? I mean, you get your principal back, right? You get your $1,000 per bond. You haven't actually lost your initial investment.
That's true. You do get the principal back, which is important. But there are still some pretty significant disadvantages. The first one is just obvious. That stream of interest payments you were counting on,
Stops cold.
gone. Just stops. If you were maybe relying on that income for living expenses or something, well, it's vanished.
Okay, so direct income loss, that's clear.
Yep. But maybe the bigger issue, the one that often stings more, especially in that falling rate scenario we keep talking about, is something called reinvestment risk.
Reinvestment risk. Explain that.
Okay, so you get your principal back, your $1,000 per bond, but now you are forced to reinvest that money.
Yeah.
Where? You have to put it somewhere in the current market environment.
And if the bond was called because rates fell,
Then the current market environment sucks from a yield perspective. It offers much lower interest rates than the bonds you were just happily holding.
right.
Investopedia had a decent example. Imagine you bought a 10-year bond paying a 5% coupon. Nice. But it was callable after 4 years. Now, 4 years pass, and maybe market rates have dropped to, say, 3%. That issuer is almost certainly going to call that 5% bond back to save money.
Makes sense for them.
Totally. But you get your $1,000 back per bond, and now you look around trying to reinvest it. Good luck finding another safe investment paying 5%. You'll likely have to settle for something paying closer to that current 3% or maybe 4%.
So the income you can generate from that same principal amount just dropped significantly.
Exactly. You lose the higher income stream you had, and you're forced to put your capital back to work at a much less attractive rate. That's the nasty combination of call risk hitting you right when reinvestment risk is highest.
You basically get your money back at the worst possible time from a yield perspective.
Precisely. And don't forget, as we just discussed, you also missed out on the potential price increase, the capital gain you might have enjoyed if the bond hadn't been callable and rates had fallen. That price ceiling kicked in.
Man, it really does sound like kind of a raw deal for the investor when rates fall. Are bondholders just completely exposed here? Are they totally at the mercy of the issuer's whim, or are there like contractual features that offer some kind of shield?
Thankfully, yes. There is a really crucial protective feature typically built into callable bonds. It's called call protection.
Call protection. Okay, what does that do?
It's a specific period of time right at the beginning of the bond's life, and it's spelled out in the indenture. During this period, the issuer cannot call the bond, period. Doesn't matter how far interest rates fall.
So a lockout period, a guaranteed minimum holding time.
Exactly. It's a defined window of safety for the investor, protecting them against that call risk, at least initially.
Okay.
Now, once that call protection period ends, the very first date the issuer is legally allowed to exercise their call option. That specific date is known as the first call date.
First call date. Got it.
And the indenture might also lay out a schedule of later dates when it can be called, maybe with slightly different call prices, or it might just become continuously callable anytime after that first call date. Depends on the bond.
The length of that initial call protection period seems like it would be incredibly important then, right?
Oh, massively important.
Yeah.
And the Schwab material really highlights this. The duration of that protection dramatically changes the actual call risk you're facing as an investor.
How so? Give me an example.
Okay, well, imagine you buy a 10-year bond. Sounds long-term, but maybe it only has call protection for the first 6 months.
6 months. That's barely any time.
Right. In that case, you have minimal protection. After just half a year, if interest rates happen to have dropped, bam, your bond is immediately vulnerable to being called away. Offers very little security against that early call risk.
Okay, that's one extreme. What's the other?
We'll contrast that with another 10-year bond. But this one might have call protection built in for the first, say, 9 years.
9 years out of 10. Now that sounds like real protection.
Totally different ballgame, isn't it? If your 10-year bond is non-callable for 9 whole years, barring default, obviously, that you're going to receive those coupon payments and hold that principal for at least that long. Any ups and downs in market rates during those first, say, 8.5 years, they don't matter in terms of triggering an early call for refinancing. And crucially,
Yes.
within that long 9-year protection window, if market interest rates do fall significantly, the price of that callable bond can actually rise well above par, potentially behaving much more like a non-callable bond.
Why? Because the threat of an immediate call isn't hanging over it.
Exactly. The call option is so far off in the future, 9 years away, that it doesn't really cap the price today. Investors are willing to pay a premium because they know they'll get to keep the bond and its higher coupon for a long time.
So a long call protection period effectively makes the bond act more like a non-callable bond for a big chunk of its life. It gives you that potential price appreciation if rates fall during the protected window.
That's it. The length of call protection is, you could argue, almost more important than the final maturity date when you're thinking about how sensitive the bond's price will be to interest rate changes, especially early on.
Fascinating. So it's definitely something you need to check. You can't just assume.
Absolutely. It's a critical detail buried in the bond specs.
Okay, this conversation suggests that, not all callable bonds are created equal. We've mostly been talking about what sounds like a standard call option, the one used mainly for refinancing when rates drop. Are there other kinds, other flavors of call provisions out there?
Yes, definitely. The sources do talk about different types. What we've been focusing on is the most common, let's call it traditional call option. That's where the issuer calls the bond, usually at par or maybe a slight premium, primarily driven by that desire to refinance at lower rates.
Okay, the standard one. What else is there?
Well, Schwab in particular mentions another type, which sounds quite different. It's called a make-whole call.
A make-whole call. That sounds nicer. Like it's trying to compensate the investor for something.
That's exactly the idea behind the name, yeah. If an issuer decides to exercise a make-whole call, they don't just hand you back the par value, the $1,000.
Yeah.
No, they have to pay you a premium on top of the principal. And that premium is specifically calculated to, make you whole for the future interest payments you're now going to miss out on because they called the bond early.
Whoa. Okay, how do they figure that out? How is that premium calculated?
The bond's indenture, again, the contract, will spell out the exact formula. But generally, it's based on the present value of all the remaining coupon payments you would have received, plus the final principal repayment if the bond had just run all the way to its original maturity.
Okay, present value.
Yeah.
So they discount those future cash flows back to today's dollars.
Exactly. They use a specific discount rate, usually based on a relevant benchmark, like a U.S. Treasury yield of similar maturity, plus a little extra spread that's also defined in the contract.
So instead of just getting $1,000 back, you get $1,000 plus this lump sum that represents the estimated value today of all the future income you just lost.
That's the basic concept, yes. You're being compensated for the early termination of those expected cash flows. It's designed to leave you, theoretically, economically indifferent to the call.
That sounds expensive for the issuer. Does this mean they use make-whole calls for the same refinancing reasons as traditional calls, like just to grab lower rates?
No, and that's a really key distinction. The sources emphasize that make-whole calls are actually rarely used primarily for refinancing. Why? Because the cost of paying that big make-whole premium is usually so high.
It eats up any savings from lower rates.
Pretty much. It often outweighs any benefit they'd get from refinancing the debt at a slightly lower interest rate. So it doesn't usually make economic sense for that purpose.
Okay, so if not for refinancing, Why would an issuer ever exercise a make-whole call? Why pay that premium?
It's typically triggered by different circumstances. More often, it's related to major corporate events. Think like one company acquiring another. The acquirer might want to clean up the target company's balance sheet and retire its existing debt as part of the deal.
Ah, okay. Or other strategic moves.
Yeah, maybe a company just decides strategically they want to significantly reduce their overall debt levels for reasons unrelated to current interest rates. It's more about facilitating those kinds of structural or strategic changes within the company rather than just chasing cheaper borrowing costs in the market.
Interesting. So different trigger, different economics. How does having a make-whole call feature affect the bond's price behavior? Does it still put that cap on the price when rates fall, like a traditional call does?
Another crucial difference. Generally, no. Bonds with only make-whole call provisions tend to behave much more like non-callable bonds when it comes to price appreciation if interest rates fall.
Really? Why is that?
Because the call price isn't a fixed number like $1,000. It's a calculated value principle, plus that make-whole premium that moves, in a way, with interest rates because it's based on discounting future cash flows, since it compensates the investor for that lost future value.
It doesn't create that same artificial ceiling.
Exactly. The bond's price can still rise significantly above par in a falling rate environment because the market knows that if it is called early via the make-whole, the investor gets compensated for that high coupon they're giving up.
Right.
The make-whole provision doesn't impose that same kind of hard cap near par that a traditional call does.
Wow, okay. That's a really, really important distinction for an investor to understand. A make-whole call is fundamentally different from a traditional call when you're thinking about potential price gains.
Absolutely. It changes the whole risk-reward profile, especially regarding interest rate sensitivity, compared to a bond with that standard, often par, call option.
Good to know.
And while we're talking about bonds that behave differently regarding early redemption, maybe we should quickly mention the polar opposite of a callable bond.
Which is?
The bullet bond.
Bullet bond. Sounds straightforward, like go straight to the target date.
That's exactly the idea.
Yeah.
A bullet bond is structured super simply in terms of repayment. The entire principal amount is paid back in one single lump sum, precisely on its stated maturity date. That's it.
No funny business, no early calls?
Nope, no call feature. Usually no sinking fund provisions either, which are another way principal can sometimes be paid back early. Nothing that messes with that single defined repayment date at the very end.
Okay, so if your absolute top priority is knowing exactly when you'll get your principal back and how long that income stream will last, a bullet bond gives you that certainty.
Pretty much, yes. Barring default, of course.
Right. So let's recap the types then. You've got your bullet bond. Pays back everything strictly at maturity. Predictable. Then the traditional callable bond issuer can call it early, often at par, usually to refinance if rates fall, introduces uncertainty and reinvestment risk. And then the make-whole callable bond issuer can call it early, but has to pay a hefty premium to compensate you for lost income, usually triggered by corporate events, not rate drops, and behaves more like a non-callable bond, price-wise.
That sums up the main categories regarding the early redemption feature quite nicely.
Yeah.
And yeah, knowing which type applies to any bond you're considering is absolutely vital.
Definitely. Okay, so we've covered the what's and the how it affects investors, but let's zoom out again. You mentioned that University of Florida study. What did it find about why companies choose to issue callable debt in the first place? Beyond just the obvious refinancing angle, what factors did the research show were driving this decision?
Right. This was a pretty rigorous academic study published back in the day in the Journal of Financial Economics. They looked at a really large data set of corporate bonds issued between 1977 and 1986.
Okay, a specific time period.
Yes. And they gathered data on over 2,000 different bond issues from financial companies, industrial firms, and utilities. And they carefully compared the characteristics of the bonds that were callable versus those that were issued without a call feature.
And they crunched the numbers to see what predicted whether a bond got the call option.
Exactly. They used a statistical technique called logistic regression. It's basically designed to figure out the probability of something happening or not happening, in this case, having a call option versus not, based on a whole bunch of potential influencing factors. They were trying to test various economic theories about why call options even exist on bonds.
Okay, so what did the stats show? What factors really stood out as being significant predictors of a bond being callable?
Well, they found pretty strong evidence supporting several factors that, economic theory had already suggested might be important. First off, debt maturity. That was a big one.
Meaning?
Bonds issued with longer maturities, think 20 or 30 years instead of 5, were significantly more likely to have a call feature included.
That kind of makes intuitive sense, doesn't it? The longer the bond's life, the more chance there is for interest rates to make a big move, which makes that refinancing option potentially much more valuable to the issuer down the road.
Precisely. A longer runway gives more opportunity for rates to fall, enough to make calling worthwhile. Okay, second key factor. The level of interest rates that were prevailing right when the bond was originally issued.
How did that play in?
Bonds that were issued during periods when market interest rates were already high were also significantly more likely to be callable.
Again, that feels logical. If you're forced to borrow money at a really high rate today, you definitely want the option to get out of that high rate later if market conditions improve, right?
You got it. You're paying a premium interest cost now, so you want that escape hatch in case rates drop substantially later on. Makes perfect sense. Now, a third factor they found significant was the issuer's default risk.
Default risk? You mean like how likely the company was to go bust?
Yeah, essentially measured by things like their credit rating. The study found that bonds issued by companies with higher default risks, so lower credit ratings, were statistically more likely to be callable.
That one's maybe less immediately obvious than rates or maturity. Why would a riskier company be more likely to want to issue callable debt? Wouldn't investors demand non-callable from them?
It's an interesting finding. The study notes the statistical significance lower-rated firms in their sample were more associated with callable debt. Now, the why is debated in academic circles. It could relate to complex interactions involving financial distress, maybe signaling theories, or perhaps how call options interact with other covenants in the bond indenture for riskier firms. The study itself mainly identifies the strong empirical link in their data from that period, rather than definitively proving the exact causal mechanism.
Okay, so an empirical finding. Riskier firms during that 77-86 period tended to issue callable bonds more often.
Interesting.
What else did they uncover?
Another finding, maybe less obvious again, related not just to the bond, but to the type of company issuing it. Specifically, they looked at growth firms.
Companies expected to grow fast.
Exactly. And the study found that these growth firms were statistically more likely to include call options on their debt compared to more mature, stable companies.
Growth firms using call options. What's the theory there? Why would a company focused on rapid expansion want the ability to call back its debt early?
Well, the explanation often discussed in finance theory, which the source sort of nods to when mentioning agency costs, is about managing potential conflicts between the company's owners, the equity holders, and its lenders, the debt holders.
Okay. How does a call option help there?
Think about it. If a company grows really successfully, becomes much more valuable and less risky, the value of its existing fixed-rate debt actually goes up for the bondholders, right? They get the same coupon, but from a safer company. A call option gives the equity holders, who are the main beneficiaries of that growth, the power to buy back that debt at a fixed price, like par.
So it stops the bondholders from getting the full benefit of the company's success, in a way.
It limits the wealth transfer to bondholders that might otherwise occur if the firm's prospects dramatically improve. It preserves more of that upside value created by growth for the equity holders. It also provides financial flexibility. Maybe they can call the old debt and issue new debt more cheaply later to fund even more growth. It basically gives the owners, the equity holders, a lever they can pull that can potentially enhance their own returns, especially in a high-growth scenario.
Fascinating. So it's not just about external market rates. It can also be about managing those internal dynamics and incentives between owners and creditors, especially for companies on a fast growth track.
Exactly. It adds another layer to the why.
Did the study find any differences in using call options across different industries? Like, did utilities behave differently from banks or manufacturers?
Oh, they absolutely did. And the differences were quite stark, actually. Utility companies stood out. They showed a significantly higher tendency to issue callable bonds compared to everyone else in the sample.
Really? How much higher?
Get this. In their data set, a whopping 93.3% of the bonds issued by utility firms were callable. That compares to an overall average of about 80.3% for all the firms they looked at.
Wow. Almost all utility bonds were callable then. Any reason why utilities specifically?
The study mainly points out the statistical difference, but you can speculate. Utilities, they have massive long-term infrastructure investments. They're often regulated monopolies. They face different market conditions. These structural factors likely shape their financing strategies and perhaps make that call option particularly valuable for them over the very long term.
Makes sense. And what about the other sectors they looked at?
Well, financial firms, banks, insurance companies, etc., they actually showed the opposite tendency. They were more likely to issue non-callable bonds compared to both utilities and industrial firms.
Okay, so financials lean towards non-callable and industrials.
Industrial firms were kind of in the middle. The differences in the callable versus non-callable mix across these three broad sectors, utilities, financials, industrials, were statistically significant in the study. So yes, the industry you're in definitely seemed to play a role in the likelihood of issuing callable debt, at least back in that time period.
Very interesting. So we have maturity, initial rate levels, default risk, growth characteristics, and industry type all playing a role. Now, did the study find anything that people thought might matter, but actually didn't turn out to be significant in their analysis?
Yes, and this is where some prior theories got challenged a bit by their findings. One surprising one was interest rate uncertainty.
Meaning like how volatile rates were expected to be in the future.
Exactly. Some theories had proposed that if future rates were really uncertain, that would make the call option more valuable, like insurance against big rate swings. But this study's data did not find a statistically significant link. Higher uncertainty did not lead to more callable bonds being issued in their sample.
That is surprising. You'd think more uncertainty would make the option more attractive.
It feels intuitive, yeah, but the empirical results here didn't back it up as a major driver. Another factor that came out as not statistically significant was the firm's tax bracket.
Corporate income tax rates.
Right. There had been some arguments suggesting that maybe the tax treatment of call premiums paid or other related costs might influence the decision. But again, this study looked at the data from 77 to 86 and found no significant relationship between a firm's tax situation and its likelihood of issuing callable debt.
Okay, so the big drivers they confirmed were maturity, starting interest rates, default risk, being a growth firm, and industry. But interest rate uncertainty and corporate taxes didn't seem to be major factors in that period, according to their analysis.
That's the picture their empirical work painted, yes. Yeah. It really helps add some data-driven nuance to understanding the complex mix of factors behind the issuer's decision, beyond just a simple rates fell, let's refinance story.
Gives us a much deeper perspective on the issuer's side.
Okay, great. Let's completely switch gears now. We're going from the academic, why issue it, to the very practical, maybe even a bit technical, how do you account for it side. You mentioned this document from the Fed referencing something called ASU 2017-08.
Yes, exactly. This takes us into the weeds of accounting rules, specifically U.S. GAAP generally accepted accounting principles. The source material discusses a specific update issued by FASB, the Financial Accounting Standards Board. It's called Accounting Standards Update 2017-08, and it came out in March 2017.
Okay, ASU 2017-08, what did it do?
It specifically changed the rules for how certain financial institutions think banks, insurance companies, maybe large investment funds have to account for the premiums they pay when they buy certain kinds of callable bonds in the market.
Premiums, meaning when they buy a bond for a price above its face value, above par. Exactly. If they pay, say, $1,050 for a $1,000 par value bond, that extra $50 is a premium. It represents an additional cost of acquiring the bond, and under accounting rules, that cost needs to be spread out or amortized as an expense over the life of the investment.
Okay, so you expense that premium over time. What was the old rule for callable bonds?
Under the old GAAP rules, for most callable bonds, that premium was generally amortized or spread out over the bond's entire contractual life, all the way to its final maturity date, even if it was callable much earlier.
So if it was a 20-year bond callable in 5 years, you'd still spread that premium expense over the full 20 years?
Generally, yes, under the old guidance.
Okay, so what did this new rule, ASU 2017-08, change?
It changed that treatment for a specific subset of callable bonds. Those purchase callable bonds that have explicit non-contingent call features where the issuer can call them at fixed prices on fixed dates. Think of your standard traditional callable bond.
Okay, the common type.
Right. For those specific bonds, if an institution buys them at a premium, the new rule requires them to amortize that premium only down to the earliest date on which the issuer can call the bond.
Whoa, okay. So back to my example. The 20-year bond callable in 5 years if you buy it at a premium.
Now, you have to amortize that entire premium over just those first 5 years, ending at the first call date, not over the full 20 years anymore.
That seems like a big change. The amortization period could be drastically shorter.
It can be, absolutely. Instead of spreading that cost thinly over 20 years, you might be recognizing it much more rapidly over just 5 or maybe even just 1 or 2 years if the first call date is soon.
And why does this matter from a practical standpoint? What's the effect on the institution's financial statements?
Well, it significantly impacts the calculation and reporting of the bond's effective yield on their income statement, particularly in those early years before the first call date.
How so?
If you're amortizing a premium much faster over a shorter period, that means the annual premium amortization expense is much larger in those early years. This larger expense directly reduces the amount of interest income recognized from the bond. So the reported yield on that bond looks lower in the years leading up to the earliest call date compared to how it would have looked under the old rule.
Ah, I see. It forces them to recognize a lower, perhaps more conservative yield upfront, reflecting the possibility that the bond will be called early and they won't earn that high coupon for the full term.
Exactly. It aligns the accounting more closely with the economic reality that the yields might effectively end at that first call date if rates fall. It provides, you could say, a more realistic picture of the minimum yield the institution can expect if the bond gets called at the first opportunity.
So if a bank buys that 20-year bond callable in 5 years at a $50 premium, before they might have expensed maybe $2.50 a year for 20 years. Now they have to expense $10 a year for just the first 5 years. That's a much bigger hit to reported income in years 1 through 5.
That illustrates the effect perfectly. It accelerates the recognition of that premium cost into the period before the first call. Now, the source does note an exception.
Okay.
If an institution holds a really large portfolio of very similar callable bonds, and they have good data showing that prepayments, meaning calls, are probable, and they can reasonably estimate the timing and amount, well, in that specific portfolio scenario, they might still be allowed to factor those estimated future prepayments into their effective yield calculation over a longer estimated life, potentially beyond the first call date. But that's a specific exception for certain large managed portfolios.
Got it. So a specific rule targeting premiums on certain types of purchased callable bonds, changing the amortization period to the earliest call date. Did this ASU change anything else? What about bonds bought at a discount, below par?
Good question. The source is clear on that. ASU 2017-08 did not change the accounting for debt securities bought and held at a discount. If you buy a bond for less than par, that discount is still generally amortized as additional income over the bond's full contractual life all the way to maturity, subject again to that same portfolio-level prepayment estimation exception.
Okay, so the change was specifically about premiums, not discounts. And when did this new rule actually kick in? When did institutions have to start doing this?
It became mandatory for public companies for their fiscal years starting after December 15th, 2018. And for private companies, it was a year later, fiscal years starting after December 15th, 2019. Early adoption was allowed, though.
So this change is already baked into how financial institutions report their results now.
Yes, it's the current standard practice for accounting for these specific types of callable bond premiums.
All right. Wow, we've covered a lot of ground. From the basic definition, the risks like reinvestment risk, the different flavors like make-whole calls, the deep dive into why issuers use them based on that academic research, and even this technical accounting standard, let's try to bring it all back home. What does all this really mean for you, the individual investor, maybe holding some bonds or thinking about buying some? What are the key takeaways?
I think the absolute number one takeaway is simple but crucial. Know your bond. Before you hit buy, or even if you already own a bond and maybe haven't checked this detail, dig into its specifics. Look at the prospectus, the trade confirmation, the offering documents. Find out, is this bond callable?
And if the answer is yes, don't stop there, right?
Absolutely not. If it is callable, you need to understand the terms. What type of call is it? Is it that traditional call, probably at par, that signals refinancing risk if rates fall? Or is it a make-whole call, which behaves differently?
And
Critically, find the call protection period. How long are you genuinely safe from an early call? And what is the exact first call date? As we discussed, a bond callable next year is a totally different beast from one callable in 10 years, even if they both mature in 20.
And once you know those terms, you need to think about how an early call might actually affect your own financial plan.
Yes, exactly. Are you building a bond ladder where having bonds mature predictably is important? Are you relying on that specific bond's income stream for a set number of years? If so, a callable bond throws a wrench into that certainty. Getting your principal back unexpectedly early, especially if it happens when rates are low, could force you to adjust your whole strategy. You might have to scramble to find a replacement investment and likely settle for a lower yield. So if that predictability of maturity and income duration is really, really important for your goals,
Maybe stick to bullet bonds. Or look for callable bonds with really long call protection periods.
Those would certainly reduce or delay the uncertainty associated with the call feature, yes.
Now, we mentioned earlier that callable bonds often have to offer a slightly higher yield than similar non-callable bonds. Is chasing that extra yield always a good idea?
Well, that slightly higher yield is essentially your payment for taking on the call risk and that associated reinvestment risk we talked about.
Compensation for the uncertainty.
Right. So you need to weigh it up. Is that extra bit of yield, maybe it's 0.2%, maybe 0.5%? Is it truly worth the potential disruption? Is it worth the risk that you'll get your money back precisely when it's hardest to reinvest it well? There's a definite trade-off there. And the right answer depends on your individual circumstances and risk tolerance.
Makes sense. And one last point, perhaps. Just because a bond is callable, say starting next year, should you automatically assume it will be called on that first call date?
Oh, definitely not. Remember, the call is an option for the issuer, not an obligation. They will only exercise that option if it makes economic sense for them.
Which
Mainly means if market interest rates have fallen significantly below their bond's coupon rate. If rates have actually risen since they issued the bond, they'd have zero incentive to call it early and refinance at a higher rate. They'll happily keep paying you the lower coupon. Their own financial health and strategic needs also play a role.
So the call might happen, but it's not guaranteed. It depends entirely on market conditions and the issuer situation when that call date arrives.
Correct. However, in a falling or low interest rate environment, it's probably wise for you, the investor, to operate under the assumption that an early call is a very real possibility for bonds that are past their call protection period.
Which implies that for callable bonds, especially when rates are low, that earliest call date might be a much more relevant date to focus on for your planning and yield expectations than the final maturity date listed way out in the future.
Absolutely. Looking at calculations like yield to worst, which often assumes the bond is called the earliest possible date, can give you a more conservative and potentially more realistic picture of the return you might actually achieve.
So due diligence on that call feature is just paramount. You can't ignore it. Don't just look at the coupon rate and the final maturity date and think you know the whole story.
You really don't. The call provision changes the game.
Okay, so let's try to wrap this all up. Bond call provisions. They give flexibility and potential cost savings to the issuer, mostly driven by the chance to refinance if interest rates fall. But for you, the investor, they introduce significant uncertainty and that tricky reinvestment risk. Understanding the specific terms, is it traditional or make whole? What's the call price? How long is the call protection? When's the first call date? That's absolutely essential before you invest.
Can't stress that enough.
And we learned that factors like how long the bond runs, maturity, the interest rates when it was issued, the issuer's credit risk, and even whether it's a high-growth company can all influence why these features get included in the first place, based on that academic research.
And even how institutions account for the premiums has specific rules tied to that earliest call date.
It's definitely a complex feature, but as you said, it's incredibly widespread in the U.S. bond market, corporates, agencies, munis. Ignoring it means you're really ignoring a fundamental characteristic of your potential investment.
You're flying blind on a key risk factor.
So maybe here's a final thought to leave everyone with as they navigate the bond market. In a world where interest rates are always moving, sometimes unpredictably, that idea of a guaranteed return and a guaranteed principal repayment date from a bond, well, it isn't always quite so guaranteed for the full stated term if there's a call provision lurking in the fine print. How does that potential for an early, maybe inconvenient, return of your capital fundamentally shape your perception of bond safety versus bond yield? And maybe more pointedly, does that little bit of extra yield you might get on a callable bond truly compensate you for the risk of having your investment handed back just when finding a replacement at a decent rate is hardest?
That's definitely something worth mulling over carefully as you evaluate any bond investment that isn't a straightforward bullet bond.
Absolutely. Well, there's always more to uncover in the world of finance, isn't there? But diving into these kinds of specific details, like bond call provisions, hopefully helps all of us navigate it just a little more wisely.